I want you to think about something for a second. Every single day, millions of people buy stocks. They buy bonds, they buy crypto, they scroll through headlines about the Fed, about earnings reports, about interest rates, and almost none of them, almost none, are paying attention to what Bank of America just quietly put in front of the entire financial world. Not a press release, not a tweet, a full detailed metals research report from Michael Widmer, the head of metals research at one of the most powerful banks on the planet. And buried inside that report is something that changes the way you need to think about silver. Not in 10 years, not eventually, right now, in 2026. The secret is not about silver going up. That part everybody knows by now. The secret is about why silver is going up, and why the reason behind this move is unlike anything the silver market has seen in modern financial history. So stay with me, because by the end of this video, you're going to understand something about silver that most investors, including most professionals, still do not fully grasp. Here is the core of what Bank of America revealed. And I want to be precise because the details matter. Most people who have heard about Bank of America's silver forecast think the story is the price target. They think the headline is $309, but the real story, the secret, is not the number. The secret is the structural shift underneath the number. Michael Widmer's report makes one argument above all others. Silver has permanently changed its identity. For most of the past century, silver was primarily a monetary metal, a store of value, something you bought when you were afraid of inflation or currency debasement, and it still is that. But in 2026, silver has become something more. It has become what Widmer calls an economic structural metal, the kind of metal that entire industries cannot function without. The kind of metal that, if it disappeared tomorrow, would shut down the global solar energy industry, the electric vehicle supply chain, and the artificial intelligence infrastructure build-out simultaneously. That is not hyperbole. That is engineering reality. And it is the secret that Bank of America is now saying the market has not yet fully priced in. Let me explain what it means for silver to be a structural metal, because I think this concept is the most important thing you can understand about silver in 2026. Think about iron. Iron was the structural metal of the Industrial Revolution. Without iron, and then steel, there were no railroads, no skyscrapers, no bridges, no factories. The entire industrial economy was built on it. It wasn't optional. It wasn't a preference. It was the foundation. Now think about what is being built today. Solar panels are going up on rooftops, on farms, in deserts across every continent. Electric vehicles are replacing combustion engines at a pace that was unthinkable 5 years ago. Artificial intelligence data centers are being constructed at record speed to power the next generation of technology. And every single one of these, every solar panel, every EV, every AI server, requires silver, not gold, not platinum, silver. Because silver has the highest electrical conductivity of any element on the periodic table. It cannot be efficiently replaced. Manufacturers have tried. They have spent billions of dollars trying to reduce silver usage in solar cells, and they have made progress, thrifting, as it's called, but they have not been able to eliminate it. Silver is baked into the infrastructure of the future, and that, according to Bank of America, is the secret the market is only beginning to understand. Now here is where Bank of America's secret gets genuinely alarming, and I use that word intentionally. The demand for silver is structurally growing. That much is clear, but the supply side of the equation is where the real story lives. The Silver Institute, the most authoritative research body in the precious metals world, has confirmed that 2026 will be the 6th consecutive year of global silver supply deficit. 6 years in a row where the world consumes more silver than it produces. The shortfall this year alone is projected at 67 million ounces. That is not a rounding error. That is a massive structural gap between what the world needs and what miners are pulling out of the ground. And here's the part that most investors don't understand. This deficit cannot be fixed quickly. Mining is not like manufacturing. You cannot just build a new factory in 6 months and start producing silver. New mine development, from initial discovery to first production, takes anywhere from 7 to 15 years. Permitting, environmental review, infrastructure, processing facilities, none of it happens fast. The pipeline of new silver projects coming online in the next 3 to 5 years is described by analysts as dangerously thin, which means the 67 million ounce deficit of 2026 will likely be followed by a similar or larger deficit in 2027 and 2028. This is what Bank of America means when they say silver's situation is structural. It is not a temporary imbalance. It is a sustained, multi-year mismatch between growing demand and constrained supply. And structurally, there is no quick fix. Here is another layer of Bank of America's secret, one that is more technical but absolutely critical to understanding where silver could go from here. It's called the gold to silver ratio. And right now, It is telling a story that Bank of America's research team says the market is significantly underestimating. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Today, that ratio sits at approximately 55 to 1, which means silver is roughly 55 times cheaper than gold. That sounds straightforward, but here is what makes it significant. Historically, across multiple precious metals cycles going back decades, this ratio has not stayed elevated. It compresses. It moves dramatically lower when silver outperforms gold during the later stages of a bull market. In 2011, it compressed all the way to 32 to 1. In 1980, during the Hunt Brothers silver squeeze, it fell to just 14 to 1. Now, here is where Bank of America's math produces numbers that stop people in their tracks. With gold currently trading near $4,700 to $5,000 per ounce, applying those historical ratio lows to today's gold price produces extraordinary silver price targets. A compression to 32 to 1 implies silver at 135 to 156 SLR. A compression to 14 to 1 produces the number that has turned heads across Wall Street, $309 per ounce. That is the ceiling Bank of America puts on silver in 2026. Not the base case, the ceiling. And the base case, a ratio compression toward 32 to 1, would still mean a price of $135 to $156. That is a 60% to 80% gain from today's price of roughly $87. Now, some of you might be thinking, this ratio argument has been made before. People have been talking about the gold to silver ratio for years. Why is 2026 the year it matters? That is exactly the right question. And the answer is, what separates Bank of America's analysis from generic silver commentary? The difference in 2026 is that 3 forces are converging simultaneously. And historically, it is the convergence of forces, not individual factors, that produces the biggest moves in silver. Force 1. Silver has already broken above its 45-year resistance zone. The $50 level, the previous all-time high from 1980, held for 45 years. Silver broke through it decisively in 2025 and has not looked back. From a technical standpoint, that breakout is one of the most significant events in silver's modern history. It means the old ceiling is gone. Silver is now in what analysts call price discovery territory. Force 2, the physical market is showing signs of genuine scarcity. London silver inventories have been declining. Lease rates, the cost to borrow silver, hit 39% earlier this year, a level that signals real physical tightness in the market. Force 3, institutional investors are only beginning to position in silver. Global silver ETF inflows reached 95 million ounces in 2025, more than all of 2024 combined. But total institutional holdings of silver remain a tiny fraction of total financial assets. The money has started moving in, but it has barely started. Bank of America's secret is essentially this. The physical squeeze has already begun, and the institutional demand surge has not yet arrived. When it does, the math becomes extraordinary. Here's a part of Bank of America's analysis that I think deserves more attention than it has received, and it connects silver to one of the most powerful investment themes of the decade, artificial intelligence. We hear about AI constantly, the data centers, the compute power, the chips, the infrastructure, but here's what almost nobody is talking about in the context of silver. Every data center being built to power the AI revolution requires enormous amounts of electronics, and those electronics require silver. Silver's electrical and thermal conductivity make it irreplaceable in the semiconductor packaging, connectors, and cooling systems that modern data centers depend on. The AI infrastructure build-out, which companies like Microsoft, Google, Amazon, and Meta are investing trillions of dollars into, is creating a demand for silver that was simply not part of the equation 3 years ago. And this demand is not going away when the next product cycle arrives. It is going to compound. As AI becomes more embedded in every industry, healthcare, transportation, manufacturing, finance, the data centers powering it will multiply, and every single data center will need silver. Bank of America's research specifically flags data centers as one of the emerging demand drivers for silver that the market has not fully priced in. This is not speculation. This is the next industrial wave, and silver is at the center of it. Let me move away from forecasts and models for a moment and talk about what the physical silver market itself is telling us right now, because sometimes the most honest signal comes not from analysis, but from the market's own behavior. Earlier this year, something happened that almost never occurs in precious metals markets. The spot price of silver rose above the futures price. In market language, this is called backwardation. It means that silver available today, right now, for immediate delivery, was worth more than silver promised for delivery in the future. That condition only exists when physical supply is genuinely tight, when buyers are willing to pay a premium just to get metal now rather than wait. We also saw lease rates, the cost to borrow physical silver, spike to 39% earlier in 2026. Normal lease rates are well below 1%. A rate of 39% is a 5-alarm signal of physical scarcity. Coin and bullion dealers in the United States, Europe, and Asia reported extended waiting lists. Premiums over spot price, the extra amount buyers had to pay above the benchmark price to actually receive physical silver, reached $8 to $12 per ounce at the peak. These are not statistical abstractions. These are real conditions in the real market right now, telling a clear story. The physical silver market is tight. And when the demand surge that Bank of America is describing arrives in full force, that tightness is going to intensify dramatically. Now I want to spend a moment on something that sounds contradictory at first, because I think it actually makes the silver story stronger, not weaker. The solar sector is expected to reduce its silver consumption by approximately 19% in 2026. That sounds like bad news for silver demand. And on the surface it is. The solar industry has been aggressively working to reduce the amount of silver used in each panel, a process called thrifting. And they have been successful. Silver usage per panel is coming down. But here is the paradox. Global solar installations are going up dramatically at the same time. More panels are being installed, many more, while each individual panel uses slightly less silver. The net result? Total solar silver demand is still rising, or at worst holding flat. And even if it does decline modestly, it is being replaced by demand from data centers, AI infrastructure, and automotive. The Silver Institute has confirmed that the 2% decline in total industrial fabrication for 2026 is largely offset by these other sectors. The solar thrifting narrative, which some bears have used to argue silver demand is peaking, misses the bigger picture entirely. Silver is not dependent on any single industry. It is woven into multiple industries simultaneously. And that diversification of demand is actually one of the metal's greatest strengths as an investment. History has a way of making things very clear in hindsight. Let me give you 3 examples of what happened to investors who understood this silver story early and what happened to those who dismissed it. Example 1, 2010 to 2011. Investors who recognized that the gold to silver ratio was historically elevated in 2010 bought silver and held through the cycle, watched the metal triple in price over 18 months while gold gained roughly 80%. Silver dramatically outperformed. Example 2. October 2025. Silver broke above $50 for the first time in 45 years. Investors who had been following the supply deficit data and industrial demand trends since 2023 were already positioned. Those who waited for the breakout to be confirmed chased the move and paid a 60% premium over where silver had been trading 6 months earlier. Example 3, January 2026, silver hit $121. Investors who bought in mid-2025, near $40, had tripled their money. The investors who bought at $100 thinking the move would continue, without understanding the underlying dynamics, got caught in the 36% correction that followed. The lesson in all 3 cases is the same. Understanding the structural story, the real secret, is what separates the investors who profit from those who get hurt. And Bank of America's report is essentially saying, the structural story of 2026 is as compelling as any of those previous setups. The investors who understand it now are the ones who will be positioned for what comes next. I would not be giving you an honest breakdown of Bank of America's silver analysis if I did not spend time on the risks, because they are real and they matter. Silver is one of the most volatile assets in the world. January 2026 proved that in the most dramatic possible way. Silver hit an all-time high of $121.88 on January 29th. By February 6th, just 8 days later, it was trading at $75, a 36% decline in 8 trading days. If you bought at the top without understanding the volatility you were taking on, you suffered a devastating loss in a very short period. That kind of move can happen again. And Bank of America's own analysis acknowledges it. The $300 to $9 target is described as a potential cap, not a guarantee. Getting there would require a specific set of conditions: continued gold strength, further ratio compression, physical market tightness intensifying, and institutional demand accelerating. If any of those conditions reverse, if the Iran situation resolves and oil prices drop, taking inflation fears with them, allowing the Fed to cut rates, the macro environment changes, and silver, because of its industrial sensitivity, would likely correct sharply before finding a new floor. The structural story is intact, regardless of short-term moves. But short-term moves in silver can be brutal. Position sizing matters. Never invest more than you can genuinely afford to see fall 30% to 40% in a short period. That is not a warning designed to scare you away. It is information you need to participate in this market wisely. So what are the sophisticated investors, the ones who actually read Bank of America's research, rather than just hearing the headline, actually doing right now? Based on available data and market reporting, the picture is nuanced and instructive. Physical silver investment is running strong. The Silver Institute projects physical investment demand to rise 20% in 2026, reaching a 3-year high of 227 million ounces. Retail investors in particular have been aggressive buyers of silver coins and bars, with coin dealers in the United States reporting waiting lists and elevated premiums. Silver ETF inflows have been substantial, with global ETF holdings reaching approximately 1.13 billion ounces in 2025. Institutional investors, the large funds and asset managers, appear to be more cautious and selective, entering positions on dips rather than chasing moves. They were watching the Iran peace deal situation closely and waiting for macro clarity before committing larger allocations.